This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Happy Monday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Going at it alone, Saudi Arabia decides on a unilateral 1 million barrel a day crude output for July to stabilize prices. Oil pairs early gains. Closing date, UBS expects to complete its takeover of Credit Suisse as soon as June 12th. This, as sources say, the bank is seeking to retain over 100 Credit Suisse investment bankers across Asia. Plus, we're going to be speaking to the CEOs of KLM and United Airlines this hour as profits are seen rebounding amid surging demand. We are live from the IATA AGM. First, let's get a check on your markets this morning. We are looking at tech a little bit weaker, especially considering it has led the rally in the U.S. NASDAQ 100 futures, those come in 0.1%. The overall futures in the U.S., those look a little bit stronger. Maybe we're taking some profits after a really strong tech run. Bloomberg Dollar Spot, that moves higher alongside U.S. two-year yields. Some really fiery jobs data on Friday coming in much higher than expectations, above 330,000. That had us pricing in at least one hike come July, although expectations are still widely for a pause come the June meeting. Finally, Brent crude, that is up some 2%. It was up more than 4%. It's come in a bit, but still pretty punchy. We're going to be talking to Manus Cranny about that OPEC Plus decision in just a moment. Let me show you the overall European map. It is a little bit spotty. Some are higher, some are lower. And we're talking about higher. It's where the oil majors live. FTSE 100, that's up 0.5%. CAC 40. This has really been struggling as that luxury trade has started to peter out. Can China continue to sustain that economic momentum for the luxury goods? There's some doubt over that. We also just got Euro area May services PMI coming in. It's the final reading coming in at 55.1. The prelim was 55.9, so it is slightly weaker than the preliminary reading. We saw the same come for France and for Germany, all of them still in expansionary territory. Now, UBS, we got some breaking lines on them a couple hours ago when it comes to their completion of the Credit Suisse takeover. That will happen as early as June 12th. UBS shares, those up 1.33%. The goal here, perhaps, for UBS is more certainty means an easier time retaining talent. We had a fantastic Bloomberg scoop. They're looking at retaining as many as 100 investment bankers from Asia. You kind of need that certainty in hand in order to keep them on board. Of course, the FT reporting over the weekend that they might see their earnings report delayed until August, something that we had heard UBS talk about. Now let's talk more about that oil story. It has come down from the morning's highs, but prices are still in the green after Saudi Arabia said that it will make an extra 1 million barrel a day supply cut in July. That will take its production to the lowest level for several years. The kingdom's energy minister says it's a treat for traders.
I would have to call it the Saudi lollipop, which is 1 million barrel of reduction for the start that starts at the 1st of July. And that million is also extendable.
For more on this, let's go to Bloomberg's Manus Cranny, who is in Vienna. Manus, let's just start with the OPEC Plus cut coming from Saudi. What do you make of all of it?
Backed by barrels, a reliable partner, one that when they say they are going to cut, delivers the cut. And therefore, you can look at this as being a very singular message to the market. Not only is it 1 million barrels a day of a cut, just think of where we've come from and where we will arrive by the end of July. We're coming from an ability to produce 10.5 million barrels a day down to 9 million barrels a day by the end of July. Do you want to fight with that? Do you want to mess with that? And this is the essence. Everybody else has had their targets, their quotas left unchanged within OPEC for the rest of this year. So that shows you the significance and the size of the decision made by Prince Abdulaziz bin Salman. Of course, how we got there, it was 2 days of a lot of shuttle diplomacy. You must remember that this is an optionality. He's bought himself a call option. In other words, he has the ability to continue this 1 million barrel a day cut for as long as he wants. It can begin and end whenever they decide. So that is the optionality that he has bought for himself today.
Manus, now the UAE seems to be the real winner of this meeting. What are some of the details in their new deal?
Well, everybody got their quotas left unchanged except for the Emiratis. It's long been a sore point, which is the Emiratis have an idle capacity of around 1 million barrels. In other words, they can produce up to 4. Danny, they're producing around 3. And Masroui and the Prince went head-to-head a couple of years ago on Bloomberg television during the summer, in the middle of COVID, which was they wanted a higher quota. They've demanded a higher quota. Many people have questioned their desire to remain within the family of OPEC if they didn't get a higher quota. But of course, as he left, His Excellency Masroui, I put it to him, "Sir, you got a higher quota at the expense of the Africans." He went, "No, no, no."
Those countries have all accepted a level of production that is representative, and also they've been given, like the minister from Congo mentioned, they've been given the chance until the end of November to demonstrate another level of production that they can demonstrate.
And some of those African nations will have their production reassessed later on in the year by independent assessors. Nigeria is perhaps the one to focus on, Danny. In reality, they're producing around 1.2, 1.3 million barrels a day at the moment. Their ambition back in 2002 was up to 4 million barrels. We've never really quite gotten there. This is a truth and reconciliation moment, perhaps within OPEC, which is to tighten up the baselines, tighten up the ambition, and then when a cut is a cut, it really is a cut.
Manis, thank you very much for that. That is Manis Cranny in Vienna, keeping track of the OPEC Plus meeting and fallout for us. For more on this and markets in general, joining us now is Christine Aquino, editor of our Markets Today blog. Christine, first, when it comes to oil, we are seeing oil prices now move higher by some 2%. What kind of fallout might we see from higher oil prices? Where do you look elsewhere in this market to be under pressure?
Well, of course, higher oil prices definitely will stir up, again, fears of inflation. And so some of those kind of inflation-sensitive sectors probably looking a little bit worried this morning. But really, it's been overwhelmed by just gains in the energy sector. That's definitely true in the FTSE 100. Best performer in Europe this morning, because we know Shell and BP very much enjoying those oil price gains. But yeah, I mean, I think the longer-term story here, again, that inflation impact, whether that is going to feed through to longer-term prices, but then also the longevity of the gains that we're seeing in oil prices itself, right? I think you mentioned as well, Danny, that China really hasn't been the overwhelming positive factor in markets, particularly in commodities demand, that a lot of people were expecting it to be. Yeah. And so, you know, if that's really not going to hold up its end of demand from China, then there could be worries over how long the gains that we're seeing from this production cut will last.
To that point, this headline really struck me. IATA global airline profits set to jump $9.8 billion in 2023. That is double the expectation that they had thought. And to that point, Christine, it's North America, it's Europe that's fueling that. It's not China. I mean, we continue to be surprised by the strength of the U.S. and to some degree Europe too.
Absolutely, Danny. I mean, it really is kind of a very consumer-led story that we're seeing here, right? It makes a lot of sense that airlines very much enjoying the windfall of a still resilient consumer, particularly in the U.S., but also in Europe, you know. And I think it makes a lot of sense. I think we're still seeing consumers really leaning into that revenge spending after the pandemic, going on their holidays after 2 years or so of not being able to. And even here in Europe and the UK, where the cost of living crisis very much still a factor, what we're seeing is consumers kind of prioritizing travel and cutting back on everything else, everyday essentials, so that they can go on those trips. So, you know, consumers very much still carrying this economic resilience story, particularly in the U.S.
And we also had a jobs report on Friday to sort through. I mean, it was pretty confusing. Okay, over 330 jobs added, but unemployment ticks up. Some of the wage gains slows down. But the reaction in markets has been higher front-end yields. I mean, we're still not pricing in anything other than a pause at this point, right? What is the trajectory looking at for the Fed?
Well, I think, yeah, June, pausing in June, definitely kind of a nailed-on prospect at this point. But I think what we saw the adjustment is for the Fed to perhaps reconsider those rate hikes starting from July onward. And so that's where we saw kind of some of that pricing adjustment after the jobs figure. But, you know, as far as June is concerned, I think it really is quite the Goldilocks number for the Fed. We did see that labor market still very much resilient, really holding up well. But at the same time, wage costs are kept under control. And so, this is kind of the best of both worlds for the Fed, really, when you think about it, that they are able to deliver those rate hikes potentially, and that is having an effect on wage costs, but the labor market still very much strong.
Yes, maybe immaculate disinflation is real, Christine. Thanks so much for joining us this morning. That is Christine Aquino, our Markets Today blog editor. Now, coming up, we're going to be joined by the president and CEO of KLM. That's his global airline profits, as I just mentioned, are set to soar this year. There's a lovely airline pun for you. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. The International Air Transport Association is doubling its estimate for the industry's global net profit in 2023 as a surge in flying drives up ticket prices. We spoke to IATA Director General Willie Walsh from the group's AGM.
Speaking to airline CEOs, they're very confident. Everything they're seeing, looking forward at their bookings, shows that demand continues. Now, I think it is important to point out the demand window that we look at is much shorter than we used to look at historically. So patterns of bookings have changed. But yeah, the industry is confident. There are some challenges there. But despite those challenges, we remain cautiously optimistic that this is going to be a good year for airlines.
Let's go back to the IATA AGM and World Air Transport Summit and get to the man behind that interview. It is Bloomberg's Guy Johnson, who is with yet another guest. Guy.
Thank you very much indeed, Danny. Yes, Marjan Rintel is the CEO of KLM out of Amsterdam. Joins us now. Nice to see you.
Nice to see you.
Demand is very strong.
It is.
Is it sustainably strong?
We don't know, but we focused on getting our operation in place. So last summer was a bit horrible for our customers in long waiting lines. Customers came back very quickly. We focused on hiring new staff in these difficult circumstances. We did. And we had a very smooth operation last May, and it will be this summer as well.
So you're confident this summer, less disruption than last summer?
No disruptions, hopefully, than last summer. Of course, there's always a bit of disruptions. But we hired a lot of people, so we have everything back in place.
A lot of the airlines are telling me that they have aircraft grounded, they don't have the engines they need, and as a result of which, that's one of the risk factors that they're having to deal with right now.
Yes.
How about you?
That's correct. That's for every airline in the world. The supply chain is really difficult to get what you need to get the airplanes ready. So we suffer, but we have a stable operation right now. We rented some extra airplanes to make sure that we are able to deliver what we promised.
Do you think that's a long-term phenomenon, or do you think that is something that can be resolved quickly?
Well, it depends on what you mean with quickly.
Boeing is suggesting it could last 5 years.
I think so too, probably. A couple of years at least.
Does that mean that fares stay high? Is there a link between the supply chain issues that you're seeing and the high fares that we're all...
it's more related to capacity. So we still need to recover from after COVID. Yep. So the capacity in the market is still not at 100%. And people want to travel, people want to meet. China just opened a few weeks, months. Corporates need to visit their businesses. So it's more related to capacity and bring capacity back in place than to the supply chain.
Business is coming back more slowly than premium travel, than leisure.
Yeah.
Why is that? Is it because of the high fares, or is something structurally changed, do you think?
Yeah, but that's what you see also in train operating businesses in the Netherlands, for example. People work at home, they're used to it, so they travel less. I think for corporates, normally you could fly to Amsterdam, London 5 times a week. Maybe you do it today 3 times a week. So it's the take it into account.
So the longer term trips are still on, but is it the shorter term trips that are big?
We don't know yet. China just opened last Feb. So we need to see at the end of this year how corporate travel will balance out. Will it stay around 80%? What's the difference between short haul and long haul? we need some time to really figure that out.
So it's still too early to figure out what the post-pandemic market looks like.
Yeah, but I think there will be a new normal for corporate business, which is
less than where it was.
Which is less than where it was.
How do you deal with that? How does that change the mix and the way that you run the aeroplane?
Well, what we see today, and we just discussed it, I think, last time, I'm not sure, is that high-yield leisure is really picking up during COVID and after COVID. So we introduced the premium comfort product within KLM, and our customers really like it. It's a high NPS, it's sold out. We introduced it at the 787-10, now we are going to introduce it at the 787-9. And it's a product, high-yield product, which is really liked by the customers, and that's the high-yield passenger.
And do you think you have to compensate on the other end? You have to offer business something. If business is being put off by the high fares, do you compensate? I know you're doing business light fares, you're doing other different fares.
Yes.
Is that working in terms of attracting the business customer?
It sure is. So you have the more choices you have, the better it is. Also for corporate customers, because they want to have a choice at least. If you go to New York, you can travel premium comfort during the day, flying business class during the night.
We are starting to see capacity restrictions from airports looking like they may become a more permanent feature. Somebody was joking to me last night that they're seeing more yellow number plates at Brussels Airport, which is next door to you, Dutch number plates being yellow. Are capacity restrictions meaning that you are going to lose business?
Well, we're still in a balanced approach process. So the government announced they want to reduce the capacity from 500,000 movements to 440,000 movements end of next year. So they needed to start the balanced approach procedure. It's the EU regulation, which you need to follow. It's very clearly. First, you need to count the new fleet. Then you have the operational measures. And then, as at the last resort, the last step is capacity reduction. We follow the process. We will give our input this month. All the airlines will in the Netherlands. And then it needs to count to 20% noise reduction. And let's see what they come up with.
Marjan, great to see you. Thank you very much indeed for coming to see us and stopping by to see us here at IATA. Marjan Rintel, the CEO of KLM. Danny, back to you.
Guy, thank you very much for that conversation. Really interesting to hear, again, another airline executive talking about continued supply chain issues. Now, coming up later this hour, we're going to be joined by the CEO of United Airlines. That's John Scott Kirby from the same IATA, AGM, and World Air Transport Summit in Istanbul. But first, coming up on this show, UBS expects to complete its takeover of Credit Suisse as early as June 12th. We'll talk about that date next. This is Bloomberg. Let's turn now to banking, and UBS expects to complete its takeover of Credit Suisse as early as June 12th. At the same time, Bloomberg has learned that UBS is looking to keep 100 Credit Suisse investment bankers in Asia to shore up talent where its former rival had a stronger presence. For more, let's get to Michael Moore, our managing editor of EMEA Finance. Michael, tell us where we are in the progression of this takeover and what it could evolve getting to this final completion date.
Yeah, I mean, it's obviously a complicated one that was agreed to over a weekend, so there were a lot of regulatory approvals that had to happen around the globe. It looks like they've gotten most of those in place. And then there was also hashing out the details of this government backstop and what that looked like, what assets were covered by it. And that, as of a week or two ago, was still ongoing. They were still going back and forth with the Swiss government over the details of that 9 billion franc backstop. So it seems like we're near the finish line here. We could be a week away from this deal closing. I think UBS would like to get it done so they can start firming up their plans and, seeing which bankers they want to keep and you kind of stem the exodus of talent we've seen over the last couple of months.
Right, just giving some assurances that things are going to plan. Of course, they could delay their earnings, though.
Yes, I mean, second quarter earnings are going to be a bigger deal than usual for UBS. You obviously have this giant gain coming from the Credit Suisse acquisition, but then you also get a look at the combined company's financials. And the thing that investors are really focused on is the perimeter of what will be the non-core unit that basically gives the investors an indication of what UBS wants to keep and what they want to get rid of with Credit Suisse. So that will be a big strategic look forward for the investors. And I think that's what may be the holdup and why UBS is going later than normal.
Yeah, I think we can comfortably say that the algos won't really be able to read this one in the comparables when the earnings finally come out. So we'll get back to the good old days. Michael, thank you so much for joining us on that. That is Michael Moore, managing editor of EMEA Finance, again saying that the 12th of June, that is in a week's time, could be the date when we finally get a completion of the UBS Credit Suisse deal. Now, coming up, we're going to talk UK. It's widening its lead as Europe's top destination for foreign direct investment in the financial services sector. We'll be discussing that next. This is Bloomberg. Going at it alone, Saudi Arabia decides on a unilateral 1 million barrel a day crude output cut for July to stabilize prices. Oil pairs early gains. Closing date, UBS expects to complete its takeover of Credit Suisse as soon as June 12th. This, as sources say, the bank is seeking to retain over 100 Credit Suisse investment bankers across Asia. Plus, we speak to the CEO of United Airlines this hour, as profits are seen rebounding amid surging demand. We are live in Istanbul at the IATA AGM. Good morning. Happy Monday. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Now, for all of the gloom around the impact of Brexit, the UK has widened its lead as Europe's top draw for foreign direct investment in financial services. That's according to an EY survey. The rise was thanks to an increase in American investment. For more on this, let's bring in Bloomberg's UK city editor, Catherine Griffiths. Catherine, there's been a lot of mixed messages out there about London, the attractiveness of it. So what were the details from this EY survey?
So the EY survey was really quite positive for the UK. It found that the UK had increased its lead over France, notably, as the biggest place that attracted financial services, foreign direct investment. And, you know, for all those kind of pro-UK, maybe even Brexiteer people out there, they might love to see that statistic. I think the UK was up 17%, France was down a bit, but it still was in second place. I suppose, though, what one might have to think about is whether some of that foreign direct investment had been planned previously and was kind of coming through last year. So it looked great, but it may not be the full picture.
Okay, so what does that mean going forward then? If this potentially had been planned, what happens in terms of challenges?
Well, one of the things that the survey found was that, as you say, the biggest source was from American financial services companies. But what people said in response to the survey was that what they wanted to see more of in the UK was better infrastructure and a more consistent government policy. So I think if that doesn't come through, then perhaps we might see that those numbers not looking quite so great in the future.
Is the government addressing some of those issues that were raised?
Yeah, the government is certainly keen to say that it's doing all sorts of things. It has a package that used to be kind of called Big Bang 2 that became the Edinburgh Reforms. It changed the name because it wanted to sort of emphasise that financial services, a huge part of the economy here, is a benefit to the whole country, not just London. Those reforms are kind of grinding through. They will make it easier to trade and do various things in London. But what the really big prize is, people say, is that it's all about liquidity. So if you want to get liquidity into the market, potentially you need to unleash the UK's massive savings market in the form of retirement savings. The UK has the second biggest pension savings market in the world after the US. So it's all about how to get that money pumped into the economy.
Right. Yeah, certainly a lot of chatter about that. Catherine, thank you so much for joining us on this story. That's Bloomberg's UK city editor, Catherine Griffiths. Now, we're going to be covering all things UK every week on Thursdays. That's at 9:30 a.m. London time in our half-hour special. So something to look forward to this coming Thursday. Now, I want to take you to the U.S., where we are hearing from the Defense Secretary Lloyd Austin saying that the U.S. has more desire to share defense tech with India. Now, he's currently in New Delhi at this moment, so hence why he's talking about India. Also saying that the U.S. still careful about guarding defense technology. But again, more desire to share defense tech with India. This off the back of his visit to Singapore for a highly anticipated defense forum, where we continue to see that tension between the U.S. and China. Now, we're also getting some data coming in. It is the final reading on UK PMIs. They've been revised higher. May services PMI coming in at 55.2. Now, revised higher, but very so slightly. The prelim figure was 55.1, so that's just a slight variation. But I should say it stands in contrast to France and Germany. We got those final readings in the past hour. They came in, but in reality, just across Europe, the service sector continues ahead strong. It's manufacturing where we're really seeing some of that weakness. All right, coming up, speaking of demand from consumers, we're going to hear from IATA Director General Willie Walsh on the air travel outlook for the second half of this year as IATA upgrades its view by double. This is Bloomberg.
I believe it is sustainable. Certainly, speaking to airline CEOs, they're very confident. Everything they're seeing, looking forward at their bookings, shows that that demand continues. Now, I think it is important to point out the demand window that we look at is much shorter than we used to look at historically. So patterns of bookings have changed. But yeah, the industry is confident. There are some challenges there. But despite those challenges, we remain cautiously optimistic that this is going to be a good year for airlines.
What I'm hearing from the big makers of luxury goods, LVMH is a classic example, is that they're already starting to see a slowdown in the United States in the premium market. The premium market is super strong in the States. You take a look at your forecasts, that's where a lot of the profitability pickup is coming from. Again, is that where it starts? Is that where the slowdown starts?
No, I don't think so. Certainly, if we look at patterns during previous economic downturns, and it's important to say we're still looking at economic growth at a global level in 2023 and indeed in 2024. I think there's a slight risk to some economies, but on a global basis, we see growth. And what we noticed previously is that through the cycle, premium travel actually remains quite robust, particularly premium leisure. We saw that during the global financial crisis, 2008, 9, 10, 11. The patterns of bookings there in that premium leisure segment remained quite strong.
But the Fed is trying to slow the economy down. It has raised interest rates. The ECB is trying to slow the economy down. Do you not see an effect from the central bank desire to have a slower economy, to have slower inflation?
Yeah, you do. But what we're seeing is, other factors are particularly strong. Employment levels remain very, very strong. So again, the dynamics at play today are slightly different to what we would have seen before. And I think the fact that employment levels remain strong, job creation in the US remains strong, people have confidence in continuing to spend money. So this is slightly different to what we'd experienced before, but taking everything into account, we believe that this will be a good year for aviation. And GDP growth, global GDP growth, is the single most important factor when we look at passenger growth in the airline industry.
IATA Director General there, speaking at the Airline Lobbyist Group's AGM in Istanbul. We're going to have more interviews from there today. Now, we did see some of those airline stocks move lower, mostly off the back of higher oil prices. But when it comes to some of your other stocks on the move, TUI, that is having a good day. Its price target was raised by Deutsche Bank to 143 pence. We're so far away from that. It would have to gain, some 50% to get closer to that. Deutsche Telekom, it is another down day for them. There's some fear of competition when it comes to Amazon potentially entering the market as a wireless provider in the U.S. Deutsche Telekom owns T-Mobile, so that would be competition there. Novo Nordisk, that is in talks to buy a controlling stake in the company BioCorp. We tend to see some of those acquiring companies move down in share prices because of the cost of doing so. Finally, UBS, we have a date for the completion of the Credit Suisse takeover. It will be as early as June 12th, so a little bit more security there in the timeline. All right, let's get back to the airline conversation and get to the IATA AGM and World Air Transport Summit. Guy Johnson is there with a guest. Guy.
Thank you very much indeed, Danny. Yeah, we're joined by Scott Kirby. He is the CEO, of course, of United. Scott, nice to see you. Nice to see you in person.
Yeah, great to be here in person.
When we get together. Yeah. How was Memorial Day weekend? How strong is demand right now?
Well, demand was very strong and operations were really strong. You know, Memorial Day weekend, both for United and for the industry at large, was one of the, if not the best ever Memorial Day weekend. And as an industry, we're off to a strong start operation. We've really staffed up and invested heavily.
Is it sustainable? So everybody's got great visibility over the summer. Everybody's talking about a fantastic summer. Then what?
Yeah, you know, I think demand is sustainable and is going to continue. We see just a structurally higher level, particularly of leisure demand. Yep. You know, and a couple of reasons for that. One, hybrid work makes every weekend a holiday. It gives people more time. If you're working in the office 3 days a week, you have more time to travel. But I also think coming out of COVID, spending 2 years on lockdown, people will no longer take for granted their ability to travel and experience.
You think that stuff all sticks? What I'm really trying to figure out is, have you figured out what the new normal post-pandemic actually looks like? We're still in an environment where the consumer's still got money in his pockets post-COVID. The labour market's still strong. We saw the data Friday. Yeah. Is this real? Yeah. And how long does it last for?
Well, 15 months ago, people were saying the same thing, and it's just gotten stronger. Okay. So I do think this is the new norm, and that's why I think the structural reasons are important. The hybrid work, making every weekend a holiday, gives people more time to travel, and the fact that people now appreciate travel more than you could take it for granted before, and people don't take it for granted. I think those are two structural changes, that it's structurally higher.
Business coming back more slowly, though.
Business is coming back more slowly. My view is actually the U.S. economy is in a business recession. The consumer remains strong, but we're in a business, and we see that in our business traffic, but you can also see it in the kinds of companies that sell to businesses, and you know who's doing well, who's not. Yeah. Business is probably in a recession.
That's cyclical, is what you're.
That's cyclical, and we think it's 20 to 25% below where it will ultimately be. You know, and we're going to hit our guidance this year. We're producing really good numbers, really good margins in a world where business travel is behaving recessionary.
The Bloomberg banner has been blown over.
Yeah. Either that or gesticulating too much.
Yeah, well, that's possible. Yeah. I apologise for that.
Yeah, that's fine.
We should secure these things more strongly. Is the IRA going to give you a competitive advantage over a lot of the European airlines are complaining to me that they don't have the kind of long-term support now that the Biden administration is putting in for you guys.
Well, I think the sustainability portions of the Inflation Reduction Act, some of the most important legislation that's passed in decades. And it's going to make a real difference, not just for sustainable aviation fuel, but it's going to drive all kinds of investments in real sustainability. I think the Europeans should match it. When I talk to people in the EU, I tell them the same thing. The carrots work much better than the sticks. It's what made wind and solar successful. It's the same playbook that wind and solar used 30 years ago to become successful. Everyone around the world should copy the Inflation Reduction Act.
Where you may not see eye to eye with the federal government is passenger protections. Yeah. The president's out. He says the passenger needs greater protection. You've come out and said, not so much. Yeah. Do you still stick by that? Do you think that the passenger needs greater protection at this point? You've even almost indicated that safety could be an issue as well.
I mean, first, we're running the best airline that we have in history, and the industry is running the best it has. We've made massive investments to do it. The best thing for us to do is take care of our customers. Second point I'd make is, by far, our biggest source of non-weather delays is air traffic control. Yep. The Secretary acknowledges they're 3,000 controllers short. We're trying to help them fix that with FAA reauthorization. But the third issue is important. We have the safety issue. We have the safest system industry and safest aviation system in the world. And that is built on a foundation of safety culture where people do not think about cost. It's binary. We tell them safety first, safety everything, and you should not chip away at that foundation.
But if the president wants to help the passengers, should he just staff up at the FAA? We don't even have a chief at the FAA right now.
Yeah, by far, the biggest thing that can happen to improve passenger experience and operational is to get the FAA fully staffed, by far.
Who do you think should be the next chief? Do you have any ideas? You got any names for me?
I think we should have a permanent head of the FAA. And I'll leave it to the government to decide who that should be. But the FAA has massive investment, needs leadership, needs someone in charge, and it's really hard for an interim. Polly Trottenberg has become the interim. We are excited about her. Very competent, focused, on leadership and doing the right thing. But I think the FAA and the country deserves a permanent leader. I'm not going to say who it should or shouldn't be, but we need a permanent leader at the FAA.
You're fast becoming the kind of the Pan Am of American Airlines. You've got a much bigger international footprint than many of your rivals. Yeah. That exposes you to all kinds of issues around the world, one of which is the lack of availability of Russian airspace. Yeah. For you, how big a disadvantage is that for you?
It's a big challenge for us. We were going to 5 flights a day to India, for example, pre-pandemic, and today we're flying 1 from Newark to Delhi. And the other 4 routes, we simply can't make it. The airplane can't fly far enough. And even Newark to Delhi is an extra 2 hours in the air. And so, our China service isn't back yet, but we wouldn't be able to fly most of our China routes. And so it is a big deal for us.
Federal judge pushing back against the Northeast Alliance, JetBlue, American, Spirit looks like it's going to be a tough lift now for Robin Hayes. Are we done with consolidation?
I think we're probably done with consolidation.
And that suits you, though, doesn't it?
We don't care one way or another. We got so much good things happening at United. I like that our competitors are a little distracted working on those kinds of things. But we're focused on organic growth at United, creating a great customer experience. Yep. That's working really, really well. Yep. We certainly don't want to get distracted with anything to do with consolidation.
Okay, I'm going to apologize for the banner hitting you on
That
the back of the head. Okay, as long as we're good with that.
I run an airline. We deal with stuff all day.
We're not trying to sabotage you. Yeah. Anyway, Scott, great to see you.
Thanks
very much indeed.
Thanks for having me.
See you again soon. Scott Kirby, the CEO of United. Danny, back to you.
Guy, the Fed is literally rebelling. Scott talks about recession and it refuses to stand. That somehow feels quite fitting. Bloomberg's Sky Johnson there at the IATA AGM with United Airlines CEO Scott Kirby. All right, let's get to our Bloomberg Business Flash now. With that is Leanne Gerrans. Good morning, Leanne.
Morning, Danny. The UK remained Europe's top destination for foreign direct investment projects in the financial services sector last year. According to EY, Britain landed 76 investments in 2022, up on the previous year, and more than a quarter of all projects across the continent. France, the second biggest recipient, saw a 25% drop in projects. Germany and Spain were the third and fourth most important destinations. Now, Bloomberg has learned that UBS is looking to retain more than 100 Credit Suisse investment bankers across Asia. The Swiss lender is said to be in talks to keep dozens of senior Credit Suisse deal makers in Korea, Thailand, India and elsewhere in the region. The plans don't include China, where the two banks have considerable overlap. And Airbus says the wide-body aircraft market is set to experience lengthy wait times similar to the single-aisle segment. That's because airlines are rapidly stocking up on long-haul jets, while supply disruptions on equipment like seats are limiting output. Wide-body aircraft are generally more complex to manufacture. Now, that's due to elaborate interiors. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. Coming up, everyone from sovereign wealth funds to venture capitalists are spouting Wall Street's new favorite asset class. We'll talk private credit next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Everyone from sovereign wealth funds to venture capitalists are talking about Wall Street's favorite buzzword. Higher rates and stronger fees are bringing a raft of newcomers to private credit. That's fueled a potential multi-trillion-dollar boom. But some are whispering that it could all get ugly very soon. Lucia Giftapolu, Bloomberg's asset management reporter, joins me now on this story. Lucia, really fantastic story. But the way that this industry has evolved in the past years is so fascinating, because it was this niche thing that started to grow after the financial crisis to now being something everybody wants. So what's happened here? What's made this kind of the asset class?
Well, one, I think, is that banks are pulling out more and more, so they've created a big gap and demand in the market. These private credit products are lucrative for fund managers who always want to make a bit more money. So they've all seen a need and they're using it.
Yeah, and who are the players here?
Well, I think the right question is who aren't the players here, because apart from the people who've always been doing it, you have hedge funds like Sona and Marathon, BlackRock, and even traditional asset managers like Fidelity, DWS, even SoftBank wants to get into that now. So, you know, it's an abundance of new players in the market.
Does that say peak to you, or does it say continued growth to come?
It says, let's wait and see, to me.
So diplomatic, Lucia.
Yes, I have to be, I think. The thing is, well, you know, there are predictions that this might replace like a vast part of the bond market. So, like, we're talking about trillions and trillions. But there is a slowdown right now. Fundraising is a bit, you know, has slowed down a bit. Investors are a bit more concerned about where they're going to put the money. We're not in the same environment. Interest rates are rising. So, you know, that's why I'm saying let's just wait and see.
Now, in terms of this boom, because it's all well and good to see this asset class grow, but what are the risks it might bring with it?
So these are floating rate products, which means that when interest rate go up, so do the payments. So this is good for fund managers, but borrowers will feel the stress. Their balance sheets will be challenged, and it might lead to more defaults, which in turn will hurt the funds that invest in them.
Do we have any signs that defaults are starting?
I mean, there are more defaults now than there were a couple of years ago, and places like Blackstone and Bain Capital have hired internally, they have hired in-house restructuring experts to be able to deal with that in a downturn. So there are signs that there are stresses in the market. The extent that these are going to reach is not clear yet.
How careful are they being in terms of private equity coming to them and saying, we want loans? Because obviously the banks right now are being very careful. How risk adverse are some of these private lenders to funding private equity?
I mean, there are so many new players, so it's very hard to know what vetting processes each one has. I would say, you know, the more established players know how to do this very well. They were there at the financial crisis, and this is why you see the investors now flocking more into the people they know, like Ares, Apollo, and the new entrants are finding it harder to raise money. That's not to say they don't have the right processes. It's to say that investors don't know if they have the right processes in place.
Yeah, Lucia, you're going to have to come back in a few months and give us an update on SoftBank. I'm really interested to see how that one goes.
Oh, it might be even earlier.
Lucia, where'd that diplomacy go, Lucia Giftapolu, our asset management reporter. Thanks so much for joining. Now, Lucia and I this week, we're going to be heading to Berlin. We're going to be at Super Return. It's the biggest conference for private capital. We're going to be speaking to top executives from some of the world's leading lenders in the space. That will include Apollo co-president Scott Kleiman, as well as Ares. We'll also be speaking with Carlyle and Thoma Bravo. Don't miss those interviews. Bloomberg Surveillance Early Edition, that continues in the next hour with Kriti Gupta and Anna Edwards. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Another surprise move. Saudi Arabia goes it alone with an extra 1 million barrels a day output cut in July to try to stabilize the oil market. Travel boom. IATA says global airline industry profits may reach $10 billion this year. We're live in Istanbul at IATA's annual general meeting. And now that President Biden signed the debt ceiling bill into law, the Treasury could unleash a glut of new bonds to refill its coffers. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Kriti, so debt deal done, back to focusing on Treasury markets perhaps, and of course the overall inflation story. Oil, very much a focus for us today.
It absolutely is, and essentially the ripple effects that you get from potentially higher oil prices, that's going to be crucial as, again, Anna, we talk about the inflation story and what that means for the Federal Reserve. Remember, we got a payrolls report on Friday that didn't exactly support the narrative that we were headed in the right direction, that the Federal Reserve's tighter policy was really having as big of an effect on the labor market as perhaps we wanted. Now factor in the oil story, and the hikes that you are seeing priced into the market just get larger and larger. Futures really unchanged at the moment, because at the end of the day, this is not a stock market story. It is a bond market story as we talk about the direction of the economy, not just at the whim of the Federal Reserve, but also what it means in terms of how American consumers are going to be able to kind of digest some of the inflationary standpoints, which brings us to the OPEC story as well. We'll get to that in a moment. The 10-year yield at about 373 here. You're already seeing it sell off higher by about 4 basis points. The volatility kicking in this early, Anna, tells you that you are starting to see hikes baked in. The idea of the Federal Reserve's job may not be over, and they are going to have to go much, much higher than anticipated. Does that change then the terminal rate that you're getting from the consensus on Wall Street? As yields go higher, the dollar follows. You are seeing the Bloomberg Dollar Index stronger by 0.2%. That is a big deal, again, as we talk about the ripple effects into the commodity market. But right now, currency doesn't seem to be as big of a factor as OPEC when it comes to NYMEX crude and specifically Brent crude. I'm sure you'll get to that in a moment. Trading at a 73 handle, essentially the news over the weekend putting a floor on those oil prices, Anna.
Yeah, really interesting to see those oil moves. Interesting to see if the market is concluding then that we need to see more hikes in the United States, that didn't lead to stocks really falling out of bed, certainly on Friday through the Asia session here into Europe. We see gains coming through across these global equity markets, as if it's a focus on the resilience of the US economy that kind of holds sway in the very short term. We'll see where that goes. This is the European picture, though. The FTSE 100 up by 0.6%. Some of that to do with commodities, of course. Elsewhere, we see the CAC and the DAX a little flatter, but we are off earlier lows on the European session. Let me show you some other assets in focus here in Europe, and telecoms equities, certainly a picture of positivity today. We're seeing a move of 1% higher in the telecoms sector. This follows a sell-off on Friday we saw after Bloomberg reported that Amazon over in the US might be offering some low-cost telecom products to its customers. That certainly weighed on telecom stocks over here in Europe. Brent crude, Kriti, you've been through the WTI story, up by 2% here on Brent crude. We were up by 4% or so earlier on in session on the broader oil complex, but certainly we are still seeing some moves higher as we see maybe a floor being put under oil prices from the Saudis. We'll get some analysis on that shortly. This is the Turkish lira, still on the back foot, down by another 1.1% against the US dollar, despite the fact we got confirmation that Semsek is going to return. He's going to be finance minister in the new cabinet over in Turkey, but that doesn't actually change the weaker fundamentals picture, according to Venram at Bloomberg Markets Live blog, and also Goldman Sachs, both of them talking about a weaker Turkish lira. The pound is down by 0.4%. Just putting this in to continue to tell the story of Friday, I suppose, where we saw strength in the dollar on the back of that job creation engine. That weighed on the pound, and it continues to do so today. Kriti.
Certainly something we're going to be keeping an eye on. But, Anna, to your point, the biggest story, I have to say, rocking markets comes down to commodities. Saudi Arabia will make an extra 1 million barrel a day oil supply cut in July, taking its production to the lowest level for several years. The Saudi energy minister discussed the deal at a press conference over the weekend.
I would have to call it the Saudi lollipop, which is 1 million barrel of reduction for the start that starts at the 1st of July, and that million is also extendable.
Joining us now from Vienna is Bloomberg's Manis Cranny. Manny, already starting to see a little bit of a hike when it comes to oil prices at the moment. Walk us through the thinking in Vienna at the moment.
Well, you've had a sugar rush from the lollipop. We popped about 4%, gave a little back in the middle of the morning as people digested. What is a 1 million a barrel a day cut from Saudi Arabia? It's worth almost twice those cuts that have been announced in the 2 previous cutting cycles, because these are real barrels coming off the market, and it's about backing those words with barrels. That's what Halima Croft said to me this morning as she passed by. So this is about delivering optionality. If you put it in parlance of the market, essentially what Prince Abdulaziz bin Salman has done, he has bought himself an extenuated rolling call option on oil. He has the ability to roll this million barrel a day cut forward as and when he likes. Who paid the price? The African nations. And who got the extra little bit of sugar? Well, that was the Emiratis. The Russians left this building saying, we're cutting by 500,000 barrels a day, and we will continue to cut by another 500,000 barrels a day into next year. This is a floor. Where's the optionality? Should we talk about $95 and $100 oil again? Not for a while.
Okay, so that's some of the things to consider in terms of where prices go. Manus, good morning. Who are the winners here then?
I would say the Emiratis were. Anna, they have long wrangled with their OPEC peers to say we should be able to produce more. They've idled nearly 1 million barrels. They wanted the capacity to produce more. That's the very essence of why they're part of OPEC. My sense is this is a policy of moderate appeasement. They've been offered another 200,000 barrels of oil per day from the beginning of 2024. That is what they wanted. Mazrui, His Excellency, walked out through the door. I said to him, why should you get a rise of 200,000 and the Africans pay the price? He said, no. Take a listen.
Those countries have all accepted a level of production that is representative, and also they've been given, like the minister from Congo mentioned, they've been given the chance until the end of November to demonstrate another level of production that they can demonstrate.
So the quotas have been readjusted for some of the African nations. I'll leave you with one thought in your mind. In 2002, Nigeria produced 2.4 million barrels a day. Today, that is 1.1 million barrels. This is a truth and reconciliation moment for the African nations in terms of what they want to produce and actually can produce. And that means we have a fundamental reassessment of everybody's capacity within OPEC. So when they say there's a cut beyond a unilateral move, a cut is a real cut. And everybody is at risk now in the House of OPEC of getting drawn in and sucked in to the next moves from this House. Good morning from Vienna.
Manus, thanks very much. Bloomberg's Manus Granny on the ground for us in Vienna on the winners and losers from that latest OPEC Plus news flow. Now, after the devastating effects of the pandemic, airlines are flying high once again. Bloomberg's Guy Johnson has been speaking with executives at the world's biggest airlines about how they've been facing off headwinds heading into the record-breaking summer.
Things are really busy. We had a great Memorial Day weekend, and forward bookings for the summer look really, really strong.
What we're seeing is our leisure customers, it's the strongest part of the market. The people who are filling the business cabins have the means to continue flying, and I think their priorities, it would appear, have shifted during the crisis, where travel has gone higher up.
Well, I think there's so much buffer between the demand we saw even before COVID and what we are currently seeing and able to fulfill, that this industry is less sensitive this time to potential recession than other industries. Right now, the demand is very, very high.
Demand is super strong. We see a very robust summer.
There are some challenges there, but despite those challenges, we remain cautiously optimistic.
Plenty of CEO voices then from the IATA AGM. Guy Johnson joins us now from that general meeting and that summit in Istanbul for the aviation sector. Guy, we heard a lot of really buoyant voices there, some of that being driven by strong demand, some of that being driven by strong pricing. Are airfares going to stay as high as this?
Well, certainly for the summer, it looks like they are. The question is, Anna, what comes after that? Airfares are being driven by a number of factors. They're high because there is a lot of demand right now. They're high also because there's not a lot of supply. This is an industry that remains supply constrained. You talk to the CEOs here. Do they have the aeroplanes they want? In particular, do they have the engines that they want? So there are supply side issues here as well. The top line is looking really strong. The middle of the P&L is being affected by some of those supply side constraints. So profitability, yes, it's up, but it's not up by that much. So yeah, airfares are likely to remain high. Demand is likely to be something that persists for a while. Does it last beyond the summer is a key question. But the supply side issues, they might last a little bit longer. Boeing is warning that they could last for another 5 years. Airbus is saying that they will certainly last significantly longer than this summer. So the industry is going to remain supply limited for a while. That may turn out to be a blessing, ironically, because there's a feeding frenzy at the moment, but they can't get the aircraft, so maybe they can't actually extend as far as they would like. So when the downturn comes, they might be in a better place.
Well, guys, speaking of the downturn, you had an interview with the United CEO Scott Kirby, who said that business travel specifically was already looking recessionary. Why isn't that part of the business coming back more strongly?
Yep. So there's a number of factors here, Kriti. One of which is that there is an element of cyclicality to it. I was talking to Shai Weiss as well at Virgin. He's saying that you are seeing job cuts coming through. There's a lack of deal flow in the banking sector. He's also quite exposed to what is happening in the IT sector as well. Job cuts are coming through there. So business has been more cautious coming back, partly because of cyclical factors, but there are some structural elements here as well. People are working from home a little bit more. There is also the Zoom factor, which is also increasingly represented here as well. There's also just high fares, and high fares are maybe putting business off. They're not coming back as strongly because the premium seats are being taken by leisure travelers right now rather than business travelers.
Guy, thanks very much. Guy Johnson at the Aviation conference then in Istanbul. Thank you very much for joining us, the IATA AGM. Let's turn to the banking sector now. UBS expects to complete its takeover of Credit Suisse as early as June the 12th. Plus, Bloomberg has learned that UBS is looking to keep 100 Credit Suisse investment bankers in Asia to shore up talent where its former rival had a stronger presence. Bloomberg's Leo Kensherpa joins us now with details. Leo, good morning to you. So tell us more about this takeover in terms of what it could involve. It looks as if we have a date, which isn't very far off, June the 12th.
That's true. So today's announcement was definitely a signal from UBS to its top talent as well. As you said, we reported this morning that UBS is in talks with Credit Suisse MDs across Asia that to prevent them from eventually moving on to a competitor. That's one key issue for UBS around this deal. And another key issue will be identifying what's non-core and what can be wound down, and that's likely to delay the second quarter results published by UBS. Usually they're published end of July, and now it's looking to be at some point in August.
Leo, let's go from the European banking story to the American one. The Wall Street Journal reporting that big banks could face a 20% boost to capital requirements. How did we get there? What does that mean?
Yes, so that's something that has been in motion for a while now. The Fed's Michael Barr last year said he's committed to putting in place measures that would be in line with the global Basel III standards. And there are 3 agencies involved at the moment, and they're looking to seek comments from the industry at some point. And this could get quite intense because not all banks will be in favor of the proposal. JP Morgan CEO Jamie Dimon, for example, last year called a potential increase in capital requirements bad for America.
Leo, thanks very much. Leo Kensherpa from the Breaking News team with the latest on the banking sector. Coming up on this programme, the US Treasury gearing up then to rebuild its cash buffers after President Biden signs the debt bill. More on that next. And we'll be speaking with Chris Watling, Longview Economics CEO and Chief Market Strategist. We've seen a strong rally in stocks so far this year. Does Chris think that can continue? If not, why not? We'll get to his view of the markets shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, in theory, the debt ceiling debate is in the rearview mirror over the weekend. President Biden signing that into law, essentially capping fiscal spending until January 1st of 2025. But has it been done in time? Now, from a political perspective, yes, absolutely. We hit that X date for the Treasury. But from a market perspective, perhaps we've run the clock a little bit. And here's why. The Treasury is, at the end of the day, still running out of cash. So once you kind of hit all the kind of formalities, for lack of a better term, issuance is still an issue. And now it looks like this week the Treasury, which had been delaying some of its issuance in the past few weeks, is now going to flood the market with it, to the point that you're going to see so much issuance projected that it's actually the most going all the way back to 2020 during those COVID times. The question is, can the market properly digest it? Bloomberg macro strategist Simon White joins us now to answer that very question. Simon, is the bond market ready for this kind of influx of new issuance, or are we about to look at some pretty poorly received auctions? What do you think?
Well, yeah, I mean, it certainly has the potential, to act like a very big fiscal kind of hoover on liquidity. And they need to start issuing. I mean, I just looked at the Treasury Fed account. It's the lowest it's ever been in the historical series, you know, going back 10 years, exactly as low as it's ever been, 22 odd billion. So they're going to need to start auctioning. I think as soon as today, there's 173 billion of bills being auctioned today. You know, for the whole of June, it could end up being about $500 billion. And then they've got more to go after that. It really depends, though, as far as the market's concerned, who buys those bills. If it's deposit holders at banks, that's potentially not very good for liquidity. But if it's money market funds and they're using the RRP, so they're drawing down the RRP and they're buying the bills with that, then it's going to have less of an impact. But there is certainly something to pay attention to if you're an investor here.
Certainly something to watch, Simon. But isn't the Treasury fully aware of the effect that its issuance will have on other markets and therefore might adjust that issuance calendar accordingly, or is that not the way this works?
Yeah, I mean, I'm surprised by that. I mean, they obviously have some idea about potential impact, but maybe they think their first obligation is to the fiscal health of the United States, not to the market. Okay. Right? So it's not clear what they'll do.
Something to watch there. So in terms of what weighs on stocks, interesting to note this line from Andrew Sheets over at Morgan Stanley says, while a deteriorating liquidity backdrop is likely to put downward pressure on equity valuations over the next 3 months, we also see EPS disappointment ahead as revenue growth slows and margins contract further. So another reason for stocks to turn negative, according to Morgan Stanley, although not Goldman Sachs. What are your thoughts?
Well, I mean, look, the market's been remarkably resilient, and I've started to sort of moderate my views a little bit. I think it's very easy to find reasons to be bearish for the market, but you look at some of the price action, some very long-term positive price action that you really can't ignore. As far as the earnings goes, look, I think it could potentially have an impact, but if you look at some very cyclical indicators are pointing to potentially sort of stronger earnings. So you look at, for instance, the performance of semis. Semis is one of the most cyclical industries. Generally, it leads to stronger earnings. Also, if you look at the dollar, yes, over the last few weeks it's strengthened, but over the last 6 months it's weakened. And that tends to lead to stronger earnings too. So I think it's not an open and shut case.
OK, Simon, really interesting. Simon White joining us there with the latest on his thoughts on the markets. For more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now, keeping up to date with news from around the world, here's the first word. A defense forum in Singapore kicked off with a friendly handshake between Pentagon Chief Lloyd Austin and Chinese Defense Minister Li Shangfu. But there were few other signs the two nations could avoid an eventual collision and a war like the one in Ukraine. Austin chided China for its refusal to meet unless the U.S. lifted sanctions on Li. Li launched accusations of creating divisive alliances, bullying other nations, and seeking to contain China with its support for Taiwan. India says a faulty electronic signaling system was the cause of its worst rail disaster in nearly 30 years. The search for survivors from Friday evening's 3-train collision has ended, with at least 275 people dead. Indian Railways say over 1,000 staff are now working to clear the mangled wreckage and restore services while high-level inquiry gets underway. Hundreds of thousands of people have marched through the streets of Warsaw to show their support for the opposition ahead of October's parliamentary elections. Poland's ruling Law and Justice Party has been criticized by the EU for eroding democratic standards. The demonstration, convened by former European Council President Donald Tusk, falls on the anniversary of the country's first partially free elections back in 1989. Turkish President Recep Tayyip Erdogan has named Mehmet Şimşek as Treasury and Finance Minister. It's the most prominent appointment in a revamped cabinet that will face the challenge of restoring investor confidence after elections. The choice of Şimşek hands the economic reins to an advocate of conventional policies, signaling a shift from Erdogan's unorthodox positions. Anna, one of the key market takeaways for this story in Turkey has simply been that it's meant that Turkey has been uninvestable. I wonder how quickly that reverses now that we do have this market-friendly person at the helm of monetary policy.
Well, at the home of the certainly the finance chief, at least. And what's interesting here is, yes, longer term, you're right, Kriti. A lot of people would ask, does this mean a re-rating of the Turkish currency? But in the short term, some people are suggesting this means a bigger role for the market, and actually that means a weaker lira. That certainly was the view of Goldman Sachs, put out on the Bloomberg terminal a little while ago, and also our colleague Ven Ram on the Markets Live blog suggesting this means the lira goes weaker for now. Coming up on the programme, we'll get back to some of the bigger macro themes stateside. Chris Watling joins us, Longview Economics CEO and Chief Market Strategist. Does he see the stock rally reaching its end? We'll talk about that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Another surprise move. Saudi Arabia goes it alone with an extra 1 million barrel a day output cut in July to stabilize the oil market. And travel boom. IATA says global airline industry profits may reach $10 billion this year. Bloomberg is live in Istanbul today from IATA's annual general meeting. And now that President Biden signed the debt ceiling bill into law, the Treasury is about to unleash a glut of new bonds to refill its coffers. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, it feels like the debt ceiling debate is gone, or at least in the rearview mirror, but the hangover, if you will, or the ripple effects alongside the commodity market seem to be driving the story around the world.
Yeah, absolutely. One of my colleagues tells me we'll hear more on Thursday about the size of the various issuance tranches from the Treasury, and that's going to be important in working out whether this is going to have such a big impact on liquidity, if it is going to be something that weighs on stocks. For the moment, we're pretty flat on European stocks. We actually were higher than this a little bit earlier on, Kriti, so off earlier highs. We're flat on stocks. One sector doing pretty well, outperforming the rest at least, or near the top of the pile, is the telecom sector, up by 0.4%. During Friday's session, telecoms names in Europe fell as a result of some Bloomberg News reporting that suggested that Amazon over in the US is going to start to try and sell low-cost telecoms products, and so that was weighing on sentiment for European telecoms as well. Brent crude is up by 1.8% this morning. That's also sending energy stocks a little bit higher here in Europe, so we see those oil majors moving higher as a result of this. All of this to do with Saudi Arabia, and as you mentioned in the headlines, Kriti, unilaterally deciding to cut back on production to try and put some kind of floor under prices. And this we talked about at the end of the last half hour of the programme. The Turkish lira losing 1% against the dollar or so. Once again, the focus on the cabinet that Erdogan is putting together. President Erdogan appointing Mehmet Semsek, who's a known quantity to markets. And you might have thought that puts upward pressure on the lira. But according to Goldman Sachs and our colleague Ven Ram on the Markets Live blog, this is something that will actually, in the short term at least, put downward pressure on the lira. So we'll watch that one with interest. Kriti, what do you see in the US?
Yeah, a similar story when it comes to sentiment, Anna. The idea here simply that nothing much is happening when you look at the equity story. You mentioned the stock market in Europe was unchanged. Well, futures here largely unchanged as well. 42.88 is what we're looking at on those contracts. But to me, I say all the action, it's in the bond market, because even though we're talking about oil and the changing story there, the ripple effects here for the U.S. is going to be the inflationary story, whether or not the United States, the American consumer can really handle those higher costs when it comes to commodities. The 10-year yield at 373, essentially that coupled with the payrolls report we got on Friday, putting some upward pressure on yields, really selling off in the bond market. Does that then change the pricing in when it comes to things like hikes? We're going to ask our next guest that in just a moment. 10-year yield 373 here, again higher by about 5 basis points. As yields go higher, the dollar goes with its strength in the greenback to the tune of about 0.2%, something that's not really dissuading the commodity market. We are seeing, Anna, to your point off the OPEC story here, that floor put under oil prices. Well, that shows up in NYMEX crude as well, a 73 handle on that contract, higher by about 1.8%.
OK, let's get the view on the markets then from Chris Watling, Longview Economics CEO and Chief Market Strategist, who joins me on set here in London. Good Monday morning to you, Chris.
Morning.
Let's talk about your view then for global stocks. Well, actually, no, for US stocks and where you think they are headed. We've had a strong start to 2023, of course, if you can call it a start, nearly 6 months in. But strength so far. But you think we're heading towards the top here, I think. Why so?
Yeah, I mean, it's been really interesting price action. It's been a very narrow market. Interestingly, it broadened on Thursday, Friday last week as the cyclicals got involved along with the tech stocks. But if you look at the market, I think there's quite a few big headwinds coming up, not least the fact that people have started getting a little bit greedy again. And you can see that in a lot of our sort of the risk appetite models that we look at, and I'm sure models other people look at. But, you know, as Kriti mentioned, there's all this liquidity coming up, this new issuance, $1 trillion. If you look at the TGA account, it's basically, I think, about 20 billion as of sort of back end of last week. So it's been run all the way down from $1 trillion in the middle of last year to basically zero, and now it's got to be backed all the way up. So liquidity becomes more of an issue. And of course, you know, money remains tight and it's getting tighter. And it's not obvious that story's gone away. I know the data's a bit nip and tuck and so on, but really, you know, I think the macro says recession's on its way. And if I look at the models, they say complacency in markets short term. Tech is really overcooked, and everyone believes it's going to go up forever and so on. It's a sure sign it's not, and so on.
Right, OK, so plenty of reasons to be cautious there. It's interesting, you talk about the liquidity squeeze that we might see as the Treasury brings forth this issuance to sort of top up the coffers. This is something that our colleague Simon White on the Markets Live blog flagged a few weeks ago as well, and you've been talking about it for some time. But then we caught up with Simon earlier on the programme, and he was saying, actually, when he looks at some of the price action at the moment, he's starting to see more positive signals around some of the cyclical sectors like semis. Is that something that doesn't sound like it convinces you?
Well, as I said, I mean, breadth in the back end of last week was quite good. I mean, the market broadened out. It had gone from being very tech-centric to more broadly cyclical. If you look at the sort of breadth of the market, the NYSE advanced decline line, for example, was very strong at the back end of last week. So, yeah, that's kind of exciting. But actually, if you look historically at the way cyclicals in aggregate behave at times of monetary tightening, they tend to go sideways for long periods of time and then they roll over. And that, I think, is really what we've seen in cyclicals 6-12 months, and they haven't made any headway. Look at some of these European markets. They're flat since February. Look at cyclicals across the S&P. They're flat for 12 months. So a couple of good days price action, sure. Maybe it goes on for a few weeks, but not beyond that, I don't think.
Chris, as we speak and talk about the tech story, we are literally getting a headline that Apple shares rising about 0.6% in the pre-market, hitting their closing record high level. So again, we are watching for that bid in the tech space, which brings me to kind of the marriage of the liquidity story and the growth story. If you're worried about a market that is facing a recession or some sort of concern about whether or not the bond market is really looking attractive anymore, why not go to a safer play that is really being backed by things like fiscal funding? I'm talking about the chip sector or companies like Alphabet, Microsoft, et cetera, that are actively putting money in these things like AI. Is it really fair to call it a frenzy when these are the same companies that are perceived as so safe? The premiums that they're borrowing at are at near Treasury levels.
Well, there's no such thing as a company that's so safe. I remember that argument being rolled out in late 1999, that equities were less risky than bonds. And, of course, that was near the top of the bubble. I mean, and in fact, the argument at the time was you should price tech as options because they were so special and they were going to dominate the world. I mean, you know, sure, these are great companies, no doubt about it. But as Charlie Munger says, you know, price is what you pay, value is what you get. And likes in NVIDIA, I don't know anything about NVIDIA, really. I'm not an AI expert. I'm not a tech expert. I'm a macro guy. But I do know that it's trading at 60 times forward earnings. And that's one of its highest levels outside the TMT bubble. So, you know, you've got to argue that tech's going to go into a bubble here to keep the market moving higher, for tech to remain the leadership. And you may believe that, so fine. But I'd say 9 times out of 10, when people talk about things going into a bubble, it doesn't happen. In fact, 99 times out of 100, never mind 9 out of 10. So, you know, if you want to bet on a bubble, sure. They're great stocks, but they're expensive, a lot of them. If you want to do what normally happens in markets and the narrative gets carried away as the price rallies, which I think is what happened this time, and you look for it to be overcooked, overextended, overbought, expensive, then that's what you've got in tech at the moment. And so I would bet against that leading the market from here on out.
The valuation's certainly quite scary when even you look at the recent move and even prior to that. The bulls, however, would say that if you waited for valuations to work in your favor, you'd be waiting perhaps a long time. Chris, what is your entry point here, though? What are you waiting to see from the stock market to say, all right, this is a buy?
Well, it depends on your time frame, but certainly on a month-by-month time frame, we're looking for a bit of fear to get into prices, which, you know, I think will happen over the next few months, probably over the summer. If I'm thinking longer term, sort of 6 months, 2 years plus, I'm a sort of global asset allocator. I'm looking to price in a recession. And, I think that's what we need markets to do. They haven't done that. And everyone's given up waiting for it, or some have. But the reality is the effect of tight money takes time to feed through the economy. And we've seen it. I mean, if you look at delinquency rates in offices, they are starting to pick up quite nicely. If you look at the valuation in the sexy areas of commercial real estate, that's now coming off its very rich, high price levels and starting to head to the downside. So the tight money's starting to work. We see in lots of areas of the economy, and I think that'll come. And once you get that recession, we'll start pricing into the stock market. So short term, I'm a greed and fear guy. Longer term, I'm looking for the macro fundamentals to demonstrate and for the market to price in that recession.
OK, so if we're pricing in that recession then, Chris, where does that leave the Fed? It leaves it on hold for a while, perhaps, and then eventually cutting. Maybe the jobs data on Friday caused the market to rethink when we get those cuts, push that out again. I mean, how far into the future do we have to look for that scenario, do you think?
Well, look, I mean, I think there's this debate, isn't it? Are they going to raise in June or not? I think it's, let's call it a 50-50. But the reality is they're pretty near the top. I think that's the point. The tight money's doing its work. It's working its way through the system, as I said. So, yeah, what the Fed does is they try and hold it on pause. And then, of course, if we're right about the recession, then they'll start cutting quite aggressively, I think. So we'll find out. OK, the turn could come quite quickly, I suppose, from pausing to cutting. I think so. I know the market's priced it out, or priced a lot of it out, but yeah.
OK, Chris, thanks very much. Thanks for joining us. Chris Watling of Longview Economics. Coming up, oil marching higher as Saudi Arabia vows a 1 million barrel cut. More on the commodities market. We'll talk to Ole Hansen, head of commodity strategy at Saxo Bank next. This is Bloomberg.
It was a good deal, a historical deal, and we look forward to monitor the market. But that deal is giving clarity to the market, giving the market visibility on next year.
That was the UAE's energy minister speaking at the OPEC Plus meeting in Vienna over the weekend. Saudi Arabia will make an extra 1 million barrel a day oil supply cut in July, taking its production to the lowest in years. Russia didn't commit to deeper cuts, while the UAE secured a higher quota for 2024. Joining us now for more on the deal is Ole Hansen, head of commodity strategy over at Saxo Bank. A pleasure to have you on the show. Thank you, as always, for joining us. Talk to us about the market read-through here. The initial consensus has simply been that this puts essentially a floor underneath the oil market. But in the face of this kind of consensus that a recession will hit the global economy by the end of the year, how effective might that floor actually be?
Well, good morning. And yes, that is exactly the problem we're facing right now, that the macroeconomic outlook is still very clouded, still very uncertain. We just had a strong drop report on Friday in the US, pointing to basically leaving the road open for another rate hike, and the market doesn't like that, and the oil market is the same. So we had a pop higher as expected, left a small gap, which has now already been closed. We didn't exceed the May high, basically indicating the market's not really prepared to jump back into the market on the back of this cut. In the comment from the UAE minister, he said this could bring clarity. I think it's bringing anything but clarity, because what will happen when the market starts to speculate about the 1 million barrel coming back to the market? How it's easier to cut than adding barrels back without making an impact. So I think I joined the chorus that talks about a floor in the market, because OPEC is clearly indicating that they want to actively manage production in order to ensure that prices doesn't fall further. But the upside potential seems limited at this point.
But these voluntary cuts have become almost a force of habit, it would seem, from Saudi Arabia. Could you see in the next few meetings a repetition of what we saw this weekend?
I would not think so, because then they'll yield even more market share, and if the economic outlook continues to be as challenged as it is right now, then obviously the demand will be weaker than the market is expecting, and someone has to pay for that, either through lower production or through accepting a lower price. So I think it's going to be very difficult to continue to cut if we don't see any sizable cuts from some of the other major producers at the same time. So the next 6 months is going to be very interesting to follow, that's for sure.
Ola, what do we need to know about the internal OPEC or OPEC plus politics here that sees the UAE winning out and Africa losing parts of its quota? It's not, or African countries losing parts of their quotas they've not been using. What do we need to know about that and how that's playing into these conversations?
Well, undoubtedly, that it's the announcement led. Prior to the announcement, there was some tough meetings going on because Nigeria and Angola, I'm sure they have a vision that they could bring production back to their target levels, which is now they're going to be impaired to do so. So the challenge will be in the coming months if they actually do manage or get the ability to raise production again, or how that would go down within OPEC. So that's another potential area of uncertainty and potential trouble within OPEC in the coming months. The UAE increase, they've been asking for that for a long time, and I think it's simply a question that if they didn't get it, then that would raise speculation about their future within OPEC. So they got what they needed, perhaps not as much as they wanted, but at least it's a step in the right direction for them.
Okay, something they've been asking for as a while, as you say. What about the demand story, the underlying demand story in China? Because if that's what these cuts are really all about, how do you see that stacking up? How much demand, how much resilience is there in the demand story in China?
I think it's been holding up fairly well, but at the same time we're also dealing with a country which has a massive amount of inventory levels, stock holdings, so they can actively release and take oil into storage depending on price levels. So it has not necessarily been the demand bonanza in terms of imports that we had been looking for, and the market has responded accordingly. The recovery in China will continue. I think there will still be there'll still be some initiatives coming into in the autumn in terms of stimulus to support the economy. So I think demand will remain robust, but whether it's enough to offset the potential slowdowns elsewhere, that remains to be seen. But one thing that I think the cut also indicates is that OPEC Plus they do doubt their own numbers. So the expectation for a 2 million plus barrel demand increase this year is increasingly being questioned, and we'll have to watch these oil market reports in the coming months to see whether downgrades coming to those.
Ole, the irony is that we're talking about the fundamentals driving the oil prices, but your thoughts on the liquidity story in the oil markets broadly? It feels like as the inflation story is perhaps optimistically coming to an end for a lot of consumers, is there really interest from perhaps more macro-driven traders to hop into the commodity market the way there was perhaps a year or two ago? What are you seeing in terms of kind of liquidity?
I think the liquidity clearly has left the market during the past few months, and it has raised the question. We're getting that from clients as well on a daily basis. Has the commodity rally ended almost before it started in earnest? The answer to that, I believe, is a no. We do not believe that the inflation level will come back down to the 2% central bank target. We think we have to settle for a higher level. That is attractive for commodity investments. Also, the supply right now is ample, but we see that funnel of supply starting to tighten up in the coming years, both for metals and potentially also for energy. And then right now it's bone dry in Northern Europe. We got agricultural prices at very low levels, but I'm just somewhat concerned that we may not see that last into the summer and autumn period here. So I think there are plenty of reasons to see how prices coming up, and then also hedge funds investments are very weak right now. And we all know that they are not really they will get involved if the price dictates that it's the right time to get involved. So oil investments right now are very low, and that will come back but first the price has to tell them that it's the right thing to do, and so far that signal is not coming.
Ole, thank you very much. Ole Hansen joining us there from Saxo Bank with thoughts on the commodities sector. Coming up on the programme, a look at some of the market-moving events you need to be watching for this week. We'll get you a briefing. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now let's take a look at the week ahead. And ECB President Francine Lacqua will be speaking at 9 a.m. Eastern time today. Then we'll get factory data out of the US later in the day. The RBA's rate decision is due on Tuesday. Eurozone GDP on Thursday, plus another round of US initial jobless claims, of course. And finally, CPI and PPI out of China on Friday. So data coming through from the US, from China this week. The RBA looms large, I suppose, in terms of the immediate items on the agenda then, Kriti.
Yeah, something we're certainly going to be watching on the macro front. Of course, we know what the RBA does affect risk appetite around the world, as does some of the tech trade as well, which brings us to some of the stocks we're watching in the pre-market stateside. Anna, Apple at the top of that list. Earlier in the program, we talked about how Apple hit a record high in the pre-market, trading at 181.91 right now, higher by about 0.5%. Look, it's interesting timing here, Anna, because they're about to release a mixed reality headset today. So a little bit of optimism baked in, but a little bit of optimism taking it to those record highs.
Yes, really interesting to watch how the mixed reality headset performs. Will it be an absolute triumph, or will it be something that people are reluctant to get on board with? I feel like I live in a fairly mixed reality already. Let me ask you about energy stocks. Here in Europe, the focus has been on energy names picking up from the higher oil price, leading to higher energy stocks. So the likes of, the big oil majors moving higher. But there's another dynamic to watch in the energy space, I know, stateside.
There is, and it's a little bit nerdy, so stick with me. Kind of buried in this debt ceiling agreement is approval for a natural gas pipeline that traditionally has been taken out and stripped out of previous stop funding measures that you've seen in the United States, specifically when it comes to government shutdown and really running the clock there. So at the top of my list, Anna, when it comes to the commodity trade, in addition, of course, to the big majors, is a company called Equitrans Midstream. They are the ones that are behind the $6.6 billion pipeline deal that within the debt agreement has gotten the green light. This is enormous. It's about 94% completed, and now it is allowed to actually add some of that takeaway capacity that you haven't really been able to see get developed in about the northeast region of the United States. So those shares higher by about 5%, alongside some of the majors like Occidental and Schlumberger, higher by about 1.5% as well, Anna.
Yeah, OK, so we'll watch that. Energy stocks, as I say, outperforming a little here in Europe, even if the European markets overall are off their earlier highs. Now, I know we're also focused today on a reshuffle, S&P reshuffle in focus later on this month. And sometimes you get these reshuffles that just tell you something about the way that the world has changed. And perhaps this is one of those times.
It absolutely is. A rebalancing already underway, even though you are going to see this actually take full effect later in the month. Palo Alto Networks catching a bid here, higher by 5.3%, replacing Dish, Anna, which is lower by 7.8% in the pre-market. Essentially the idea that cybersecurity, AI, the tech trade, that seems to be the future.
OK, lots to keep in focus then when it comes to surveillance. That is it for Early Edition. Surveillance is ahead. They'll be speaking to RBC's Laurie Calvasina, Atlantic Council's Ellen Wald, and Bank of America's Michael Gapin. Lots of conversations ahead then on surveillance. This is Bloomberg.